Welcome to StockTok's deep dive into Expand Energy Corp. This is an oil and gas infrastructure company operating in the energy sector, providing critical pipeline, storage, and midstream services that connect crude oil and natural gas producers to refineries and end markets. Expand Energy Corp is a capital-intensive business in a mature but essential industry. The company trades within a historical 52-week range of $91 to $126.62. As of Monday, May 11th, the stock is trading at $96.82, positioning it roughly in the middle of its annual range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Expand Energy Corp generates revenue through long-term, fixed-fee or volume-based contracts with stable industrial customers, producers and refiners who depend on its infrastructure to move hydrocarbons. The company's competitive moat rests on high switching costs. Once a customer's product is flowing through a pipeline, rerouting is expensive and logistically complex. Regulatory barriers to entry and the capital intensity of the business create additional protection. The StockTok Score on this name is 65 out of 100, a buy signal. Breaking that down, Valuation scores 17 out of 20, suggesting the stock is attractively priced relative to intrinsic value. Financial health scores 11 out of 20, a caution flag. Profitability scores a strong 16 out of 20. Growth is the weakest dimension at 1 out of 20. This is a mature, slow growth business. And smart money scores a perfect 20 out of 20, signaling high confidence from institutional investors and insiders. Now, valuation. The question every investor has to answer: are you paying the right price? Expand Energy Corp trades at a price-to-earnings ratio of 7.44 times on trailing 12-month results. That is a meaningful discount to the broader energy sector and the market overall. The forward price-to-earnings ratio is 11.07 times, implying the market expects some normalization of earnings in the near term. The price-to-earnings to growth ratio, or PEG, comes in at 0.00. This reflects the growth dimension we flagged. Essentially, no growth expectations are priced in. Enterprise value to EBITDA sits at 3.62 times, a lean multiple that again signals the market is pricing in neither significant operational expansion nor premium pricing power. Price to sales is 1.64 times, reasonable for an infrastructure operator. Our DCF model suggests the stock is trading at parity to intrinsic value. The margin of safety is 0%, meaning the market price and our calculated fair value are essentially aligned. However, Wall Street analysts have a consensus mean price target of $132 across 26 covering firms, implying approximately 36% upside from current levels. The high target is $165. The low is $100. Taking both signals together, a reasonable fair value range in our view sits between $120 and $140. That implies meaningful upside if the street's consensus is correct. On earnings, Expand Energy Corp reported a quarterly result approximately 53 weeks ago, with earnings per share of $1.10 against an estimate of $1.15, a modest miss. Revenue came in at $4.4 billion, which missed consensus expectations, but revenue growth year-over-year was a solid 31.7%, indicating underlying demand strength. Operating income was $1.6 billion, and net income was $1.16 billion. The earnings miss was modest and did not trigger a significant market repricing. Looking ahead, the next earnings date is July 28, 2026, with consensus earnings per share estimates of $1.16, a range from 75 cents on the low end to $1.56 on the high. That wide range signals uncertainty, and this earnings report will be a near-term catalyst to watch. Market sentiment around Expand Energy Corp leans bullish, with the company appearing in positive contexts as one of the better energy infrastructure plays, benefiting from investor confidence in the sector and growing demand for stable, contracted revenue streams. The valuation setup, in our view, looks compelling. A 7.44 times trailing multiple, combined with analyst targets suggesting 36% upside, positions the stock as an undervalued entry point for value-oriented investors. The mature growth profile, a feature, not a bug, for income-focused portfolios, is already reflected in the multiple, leaving room for multiple expansion if management executes. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist of financial health indicators spanning profitability, leverage, and operational efficiency, comes in at 8.0 out of 9. That is an excellent signal. Management has demonstrated disciplined capital allocation and strong operational fundamentals across nearly every metric the score measures. The Altman Z score, a bankruptcy risk model that combines profitability, leverage, liquidity, and solvency, sits at 2.70. This lands in the gray zone, not the distress range, but not the safe zone either. For context, a Z-score above 2.99 suggests low bankruptcy risk. Between 1.81 and 2.99 is ambiguous. Below 1.81 suggests elevated distress. 2.70 warrants monitoring, but is not a red flag. The cash-to-debt ratio is 0.44, meaning the company has 44 cents of cash for every dollar of debt outstanding. That is a moderate level, not pristine, but manageable for a capital-intensive business with stable cash flows. Interest coverage, the ratio of operating income to interest expense, is an impressive 19.54 times. This means the company earns its interest obligations nearly 20 times over from operations alone. Debt service is not a constraint. The current ratio, a liquidity measure of current assets divided by current liabilities, is 1.11. Anything above 1.0 is solvent. This ratio suggests adequate liquidity to meet short-term obligations. Debt to equity is 0.26, a conservative capital structure. The balance sheet, in our view, is adequate but not exceptional. The company carries moderate leverage relative to its earnings power, and interest coverage is robust, which means debt service is not a constraint. The gray zone Z-score warrants attention. We would want to see management maintain capital discipline and prioritize debt paydown if leverage increases. Overall, financial health is stable but not fortress-like. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 13.75%. This metric measures how effectively management deploys shareholder and creditor capital to generate profits. 13.75% is solid. It indicates the company generates roughly 14 cents of profit for every dollar of invested capital. Above the cost of capital for most investors, gross margin stands at 51.73%. This is the revenue left after direct costs of goods sold, in this case, after operating the pipelines and infrastructure. 51.73% is robust, reflecting pricing power and operational scale. Operating margin is 31.91%, meaning the company retains roughly 32 cents of each revenue dollar as operating profit before interest and taxes. That is exceptional. It shows disciplined overhead management and the leverage built into the business model. Net margin is 22.42%. After all expenses, debt service, and taxes, Expand Energy Corp keeps 22 cents of each revenue dollar as net profit. That is a high-quality earning stream. Free cash flow margin, the cash available for shareholders and creditors after capital expenditures, is 19.47%. This signals the company is not capital-intensive relative to its earnings, which is valuable for assessing dividend capacity and debt paydown ability. Return on equity, the profit earned per dollar of shareholder capital, is 17.65%. Return on assets is 11.43%. Both are healthy, indicating management has not destroyed shareholder capital through poor capital allocation. The profitability profile, in our view, is the strongest component of this business. The 51% gross margin and 32% operating margin demonstrate a durable, well-managed operation with substantial pricing power embedded in long-term contracts. Onto growth. Is this business expanding and at what rate? Revenue growth over the trailing 3 years stands at 2.10% annually. Over the past 5 years, growth is 0.00%. This is a mature, slow growth business. The company is not expanding its customer base or volumes materially. What it is doing is maintaining its existing infrastructure, collecting stable, inflation-adjusted fees, and returning cash to shareholders. Book value growth over 3 years is 4.70%, modestly above revenue growth, reflecting retained earnings reinvestment and, importantly, modest economic profit creation. The dividend yield is 3.25%, a material income stream for shareholders. For context, this yield is above the long-term average for the broader stock market. Management has clearly prioritized cash return over aggressive growth capital allocation. The growth picture, in our view, should be understood not as a weakness but as a feature. Expand Energy Corp operates mature, contracted infrastructure with minimal technological disruption risk. Customers sign decades-long take-or-pay agreements. They pay a fee whether or not they use the pipeline. Revenue is therefore highly stable and predictable. The 2% revenue growth reflects modest volume increases and inflation pass-through, not transformational expansion. This profile suits income-focused and value investors, those seeking steady cash flows rather than capital appreciation. Investors expecting high growth should look elsewhere. That said, the low growth baseline means surprises are more likely to be upside, not downside. If management announces a major contract win or capacity expansion, the market will likely react positively because growth expectations are low. The dividend, at 3.25% yield, provides meaningful income while the stock appreciates modestly over time. Now let's talk smart money. What institutional capital is actually doing with this name? 17 top-tier investment gurus currently hold Expand Energy Corp in their portfolios, including Howard Marks of Oaktree Capital Management, who has allocated 12.31% of his portfolio to the stock, a substantial conviction position, with no change in recent quarters. First Eagle Investment Management has also initiated or increased exposure, with an add of 1.50% to their portfolio allocation. These are not passive holders. These are active allocators of significant capital expressing conviction in the thesis. 5.6% of 13F institutional filers are net buyers of the stock, meaning more than half the position changes by major institutions are purchases rather than sales. That is a bullish signal. It suggests the smart money view is that the stock is becoming more attractive, not less. Insider ownership is notably high at 29.20%. Management and directors collectively own nearly 1/3 of the company. This is a strong signal of alignment. Executives have substantial personal capital at stake in the stock price and business performance. Over the last 3 months, insiders have made 2 purchase transactions and 0 sell transactions. That activity, while modest in frequency, is directionally positive. Insiders are buying, not selling, suggesting confidence in the valuation and outlook. When we combine 17 Guru holders, activist buying from large institutions, 5.6% net positive 13F flow, 29% insider ownership, and recent insider buying, the smart money signal is unambiguous. Big institutional investors and insiders believe Expand Energy Corp is undervalued or at least an attractive entry point at current levels. This alignment of shareholder interests and institutional conviction, in our view, is a powerful signal that management is disciplined and the business is fairly represented to the market. And finally, the verdict. Let's bring it all together. Valuation. The stock trades at a 7.44 times trailing multiple with a 31% implied upside to Wall Street's consensus mean price target of $132. Fair value, in our view, sits between $120 and $140. Financial strength. Solid but not fortress-like. The Piotroski score of 8 out of 9 is excellent. The Altman Z of 2.70 warrants monitoring. Interest coverage and leverage ratios are healthy. Profitability. This is the crown jewel. 51% gross margin, 32% operating margin, and a 13.75% return on invested capital demonstrate a durable, high-quality earning stream. Growth, mature and slow at 2% revenue growth, but this is a feature, not a flaw, for value and income investors. Smart money, overwhelming institutional and insider conviction. 17 gurus hold the stock, insiders own 29% and are buying, and 5.6% of institutional filers are net buyers. In our view, a fair value range for Expand Energy Corp sits between $120 and $140, representing approximately 24 to 44% upside from current levels. The earnings miss reported approximately 53 weeks ago was modest and did not materially alter the fundamental thesis. The business remains a stable, contracted infrastructure play with strong profitability and aligned insider ownership. The setup, in our interpretation of the data, is attractive for value investors seeking stable cash flows and modest capital appreciation with meaningful upside to analyst price targets. This is not a growth story. It is a cash return and value accretion story. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Expand Energy Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.